Hi, welcome to Forethoughts Economic Analysis. We do this quarterly. Our objective is to give you our latest thoughts on what's going on in the economy, the impact of it on investments, and then finally what we're doing. I'm Scott Pinkerton. Welcome. I'm the managing member at Forethought, and I think I've entered into my 37th year. So
fantastic.
A little bit older than you, Jake. So anyway, it's been a crazy 37 years, and I tell you, there's complacency now and there's craziness now. We're going to talk about some of those things. With me is my trusted cohort, Jake McFarland, who is a CFA candidate, and you've been one of our longest standing Economic Review members. Been helping me out for more than a couple years now.
Yeah, it's been fun. Thanks for having me on again. Excited to get into the state of the economy.
And since our last conversation, you had a paternity leave.
Yes, so we welcomed home another boy. So we've got 2 boys at home now, and trying to get to sleep where we can. And but it's been truly a blessing.
So I've had 3 girls, and then I just had my first grandson about a year ago. And maybe by the time this comes out, I'll be having my second grandson. So
lots of babies.
It is a boy. It is a boy train. So we're watching the Olympics, and last night, what happened in the Olympics?
The women's gymnastics took home gold.
And it's incredible. I mean, it's like these people aren't human. I mean, what I can do with my body and what they can do, it's like 2 different things. I mean, they're jumping in the air, hitting this pommel horse, 5 different flips, etc., and then they land it. So we thought we would call the Federal Reserve's job is to stick the landing. And the idea is you have incredible difficulty, and it's going to be really hard to stick the landing. So that's going to be our conversation today. And what we're going to do is we're going to talk about things like valuations, inflation, investor and consumer sentiment, and how that matriculates out and has an impact on you. So let's start with something that everybody's seen in the past called the street signs. And I've got my new clicker working. This is something that we invented during COVID. And the idea behind it, and Jake, you're a disciple of this, is that nobody can predict the future.
Right.
And so at the beginning of the year, we establish a base case, and we base that on 13 of the most prominent economists, and we do a little bit of our own shaving here and there, and then we say, okay, that's our base case. Now, if things start going really well, maybe we have a better scenario, and then a best case, and then obviously worse, and then the worst case. And the idea is that you don't really know, and you don't want to predict, because once you predict, what happens?
Well, you get tied to it, and when you start to do research, a lot of times you have an issue with confirmation bias, and so you base your research only on the items that support your claim.
I love my young forethoughters. They're exactly right, and that's exactly what happens, because you get confirmation bias and you start looking for data. So tell us what we're looking at here, Jake.
Well, one way we attempt to sort of avoid the confirmation bias is to think in a range of outcomes with certain levels of confidence. And so what we do is we have our base case, and as Scott mentioned, it's really driven by current economic conditions and some forward-looking expectations by some prominent chief economists. What we do then is different scenarios, and we tie those scenarios to what we call our signs to watch. These are really, really big economic indicators or just issues that might be out there in the economy. And our goal is that as time goes on, we get to see more information on those signs to watch, and hopefully they're going in the direction that the stock market is. Oftentimes they don't, and that's where things get interesting. Currently today, the S&P 500 is right around 5,600, which if you look at our signs to watch would be in the growth returns, sort of that right tail event. And when we look at the different signs, we see a lot of uncertainty, particularly around sticking that soft landing, and also a consumer that in various different metrics are weakening. Right. And so There's geopolitical risk. There is investor complacency, maybe a little bit of speculation as well. And so what we'll do today is get into some of those signs to watch and other economic indicators to kind of point our direction on how we're thinking about investing today.
It's really a strange dichotomy, and I've got my own theories on this, but people are really negative. When you look at the consumer sentiment and the polling, people think the economy is going in the wrong direction. People think that the inflation is eating them alive, and yet the statistics don't bear that out. And I want you to know that you shouldn't trust the statistics. When you get into the underneath the hood of how economics works, you quickly realize that they can only measure so much. And just because you can measure it doesn't mean it's meaningful. So for example, I was thinking about this morning as I was mentally preparing. So inflation has gone up 10% and now it's flattening, and consumer spending is staying the same. But if you're buying the same amount of goods and services, you're actually spending more.
Right.
So what's happening is people are starting to cut back, but they're still spending the same amount.
Yeah.
And so it looks like consumer spending is hanging in there. But really, people are starting to cut back. People are not going out to eat 4 times a week. They're going out to eat once a week,
right?
Something like that. So that's an interesting thing to be thinking about. Another thing, kind of my theory on it, is what's going on with baby boomers. And we'll lift that up a little bit later. But I think that we're going to have a lot stronger consumer spending for the next 5 to 10 years than what you would predict because of the baby boomer effect. So this is a slide that was really good news this week. And since this slide was done, we had our latest GDP report, and it was up like 2.9%. So what you're seeing is the long-term blue line, which is the long-term trend, and you can see the big dip during COVID. But we've recovered that dip, and GDP is growing.
Yeah. And when you think about it, when we have this sort of output gap that we had during COVID, really a mismatch between our actual GDP and the trend GDP, when that gap closes like it has, we would expect a decent bit of inflation. That tends to happen, and economies tend to heat up when that happens. But the output gap has now really all but closed.
Right.
And really that sort of relationship should bode well for inflation going forward, and we're already seeing some of those effects there. But and with all intents and purposes, real GDP has just been printing 2.5% almost every single quarter.
And this is a slide that shows inflation month over month looking good, and the point is that the CPI had its largest decline since May of 2020. We're actually seeing deflation.
Yeah.
So, and that's good news. The next slide, we break down inflation components. This is fascinating. Jake, why don't you kind of walk us through what this big old anthill looks like?
Right, and all the different colors. Really, what it boils down to is the current inflation of 3.3%. Over 60% of it can actually be attributed to shelter and auto insurance.
Right.
And
that's the blue line, and then the
blue and the red.
The red. Yeah.
Yep. So really, we can pull the data apart however you want to slice it, but we know that shelter costs are inherently lagged as it relates to CPI. And also, we have some slides to talk about insurance as well. But there is definitely a case to be made that we could see inflation continue to come down a little bit, even though it's been pretty sticky around the 3% level.
Yeah, so shelter costs, what are some of the things that are included in that? And one of the craziest things that you've shared with me in the past is owner's equivalent rent.
Right. Well, why don't you go into the next slide and we'll hit that, because I think this really tells that case. Owner's equivalent rent, to answer your question, is just if you take your home that you own, that you live in, it's your residence, what could you theoretically rent it for?
Right.
And so that goes into shelter CPI. And it's not exactly real because you own that house, you live in it, you're not going to rent it. But what I think is fascinating here in this slide, shows it pretty well, is that you can take the current rents, which is the blue line, and you can kind of plot the shelter CPI over it, which is the orange line here, and you can see how lagged it is. We had a drop back a year and a half ago down to negative 1.9% for rents. And you could see that shelter CPI went from 3.3 down to 1.5.
Right. Wow.
Then we had a big spike, and it took a while for the shelter CPI to really reflect that. But since then, we've had an enormous decline, and that's starting to work its way out of shelter CPI. But as you can see by the slide here, it's still pretty elevated at over 5%.
And you're seeing shelter, the CPI X shelter, which means if you take that away, and that's showing a 1.8%
Right.
inflation rate. So what that is signaling is the market is telling Chairman Powell, hey, need to start cutting rates.
Yep.
So I think we don't have it in our slides, but the statistics show that there's a betting market on when the Fed's going to cut rates, and it's like a 90% probability that they're going to cut in September. And of course, today the market's doing great, and I'm assuming it's probably because he said good things.
You're exactly right.
Yeah. So the Federal Reserve, we think that the Federal Reserve kind of controls interest rates, but really they follow the bond market.
Mm-hmm.
So labor is a huge part of inflation, and this is a situation where good news is bad news. And so you'll notice on the top left, job openings. What's happening is that there aren't the number of job openings that there used to be. People are looking for jobs and they're not available. You're seeing that quit rates, the number of people that say, oh, I'm just going to quit so I'll find another job. They're holding on to jobs that they have. So we're starting to see a weakening in the labor market, which is good for inflation, maybe bad for the individuals that are looking for jobs.
Yeah, good point.
Which is always a factor. And then this is unemployment and wages, and this is really critical. You want to walk us through it, Jake?
Yeah, well, it's funny when you think about the Fed's job, and they've got a dual mandate. It's almost like having two kids now, right? And so we get home, we got the two kids, and right now, our youngest, Julian, needs a lot of attention. He can't live without his mama and his dada changing some diapers and things like that. And so you can focus on that one child. Well, that's been inflation for the Fed for the longest time, and the job market's been great.
Right.
You could forget about it. It was taking care of itself. But now the
You're
Fed...
hearing from Baby Jane.
Yeah. Now the Fed's got sort of some choices to make because the labor market is starting to weaken. And as you said, maybe a good time for a rate cut to happen to sort of stimulate that. But as we look here, the data itself isn't bad yet. And
right.
So the unemployment rate at 4%, it's crept up a little bit, but still well below the historical average. And wage growth still at 7%. So while folks aren't feeling really the need to switch jobs because the grass isn't greener on the other side all the time, we're having real wage growth, which is great for consumers.
In labor supply, as this slide shows, a lot of that new workforce participation is coming from immigration. Mm-hmm. And that's a huge advantage that we have over, say, for example, Europe and Japan,
right,
which is helping our economy a lot. And you can see workforce participation is going up, especially for younger people. So I think a lot of that is immigration.
Yep.
But anyway, labor supply is okay. We're in much better shape than a lot of our trading partners. And then finally, the consumer balance sheet. But before we do that, I think I want to talk just a moment about the housing market. What we're seeing is a frozen housing market. We've got a record number of inventory of unsold homes. And my thinking on this is in 2007, 2008, you had a lot of people that owned second and third homes, and the kind of the motive back then was you used your equity line like a credit card.
Right.
And so when real estate prices went down, and they had the mortgage defaults from the credit default swaps and stuff, people couldn't afford their homes. And so you just had a glut of new homes come in and prices dropped, and the Fed had lower interest rates. What's happening here is you're having the weakness, but people don't have the debt on their homes. Mm-hmm. And so they're not so quick to just walk away.
Right. They've got equity.
Yeah, their home's down 30%, okay, but still have 70% into it. You're not going to give it back to the bank.
Sure.
And so they're not, and people have this what's the loss, sunken cost fallacy, which is, hey, I put $1 million into this home, I'm not going to sell it for $950. You'd be crazy.
Right.
It's like the market doesn't care.
No.
It's worth $900. You'd be good to sell it at $950.
Whatever somebody would buy it, that's what it's worth, right?
But people are stuck in their houses because they don't want to sell at a price lower than what they paid for it.
Right.
So much of our local economy is connected to that real estate market, and we've got a more active real estate market in Venice, Florida, than you do around the country.
Sure.
But it has no question slowed down. This is consumer balance sheet. So is the consumer in good shape?
Actually, from a assets to liabilities perspective, yes, very, very good shape. And what we did is we did a little comparison here. On the left side, you'll see consumer balance sheets 2 years ago versus today on the right side. And the assets have seen about an 8% growth. A lot of that has actually come on the side of people's homes.
Yep.
So still in the last 2 years, even though it's come down, like you said, still above where a lot of folks bought at.
And you see consumer savings. They're starting to chew through their savings.
Absolutely. And it's getting a little bit worrying. We had a buildup in personal savings from COVID. We've really worked through all of that.
Yep.
And what's even more concerning...
We're back to spending more than we make.
Exactly.
It's the American way.
But really, though, what's a little bit concerning here on the bottom right is we look at inflation-adjusted growth in deposits, basically savings rates for different income percentile groups. And we're really seeing the lower income percentile group get hammered.
Yeah.
They're racking up credit card debt.
21%, it looks like.
Down 21%. But what's also really concerning, too, is kind of the upper middle class. They're not saving anything,
right?
Which is scary because a lot of consumption is done by those two groups.
Yep. Well, again, getting back to consumption, one thing that I'm observing in Venice, Florida, and I don't know how much this universally applies, but I'm thinking about the folks that I'm having dinner with tonight. They're in their mid-60s. She was a teacher, and he had his own business. He sold the business, and he's got some health issues. And so they're going to Italy, they're going to Canada, they're traveling and spending. And she was like, well, I'm not going to, why not? So
Yeah.
I think the generations before us, like when I started as a financial advisor 30 years ago, the World War II generation was our main clients. And when they got pinched, their go-to mode of operandi was save.
Yeah.
They're Depression era kids. These are the baby boomers. And they're saying, hey, my buddy died. I don't know how much longer I'm going to have to live. My kids are fine. I'm spending.
Yeah.
And so consumer spending is stubbornly high, and that's good for our economy.
Sure.
It's just we got to get inflation under control. And it seems like it's really a Goldilocks scenario. Inflation's coming down, and we have all these reasons to think that consumer spending will be strong, but it's starting to stumble. So what does this graph here show us, Jake? We see that household debt ratio is coming back up, and what about the delinquencies?
Yeah, I think the delinquencies is a little cause for concern here because we're seeing auto and credit card loans eclipse the delinquency rate that we saw pre-COVID by a healthy margin. And while it's not back to the 2008 level, it's trending in that direction. And so we're definitely paying a close watch to that.
And in credit card interest rates, you're starting to see the impact when the Fed raises rates 5 times or 5%. It takes a while to percolate through the economy, but mortgages are, what did I see on the other day, that the average median cost to buy a home and have a mortgage has gone up 100% in 2 years because of higher interest rates and home prices not coming down. So that hurts young people. They can't buy homes.
Absolutely.
And we're seeing there's a lot of financial planning that goes into should you buy a home or should you rent. One idea is that if we've got a long-term flat real estate market, you probably are better off renting.
Yeah, they do a home to rent index, and over the last 18 months, it's been well in the renter's favor.
Yeah, our fourth, believe me, the next generation of forethoughters are Excel spreadsheet gurus. We got a spreadsheet for that. If you're thinking about asking that question, we can help you with those determinations. But that's something that I would have never thought. I thought, hey, buy the home and long term you're building up equity. But if the equity's going down, it doesn't make a lot of sense. New car financing, another example of rates are starting to percolate up and have an impact. And then insurance rates. So what I think that's interesting here is we forget to adjust things for prices. So everybody's complaining, oh my gosh, my home insurance went up 100%. And I'm thinking to myself, well, how much did your home price go up?
Right. That's a good point.
Yeah. So in Florida, we had a homeowners insurance crisis. Mm-hmm. They've done some real substantial changes to the Florida law. Like, for example, no assignment, whereas before, I remember this building here that we're in, brand new building. We've only been in here for like 4 years. And we had Hurricane Irma, and some of our roof tiles fell and they pierced this thing. And it was going to be a $4,000 fix. We had 2 roofers come in and say, we can get you a new roof. I'm going, it's just a $4,000 fix. Because it doesn't matter. It's free to you. It's like, well, okay, that's the problem.
Yeah.
So that's been eliminated. Also, they're going to only insure the new policies that are coming out post this change. They'll insure the value of the roof.
Right.
So if you have a 20-year-old roof that's worth $4,000, you don't get a replacement cost.
Right.
That's going to be a real shock to people.
Definitely.
When we have another hurricane, but it is helping the insurance companies.
True.
So this tells you that home insurance rates are going up and away, and that's been a big impact of inflation. Another thing that's happening here, though, is reinsurance costs.
Absolutely.
That undergirds the entire market, and that's just big money saying, hey, I don't want to be on the insurance business. If I'm going to be in the insurance business, you're going to have to pay me a lot. And I don't want to say it's global warming, but it's probably global warming. I mean, you got all of this damage being done. I was reading even in the Midwest, the number of tornadoes that and it's having an impact on insurance. So that'll calm things down, but it also is going to be a source of inflation.
Yeah.
Yeah. And a lot of people are going without insurance. Now, here's some good news. Do you want to take this?
Yeah, absolutely. We've had 14 straight months now positive real wage growth. So adjusted for inflation, that's going to help the wallet share, and that's good because we had a lot of things like insurance that have been harming the wallet share. So good news for consumers.
And then federal finances. So when you look at the elephant in the rooms and what can go wrong, so if you go back in time and you say, okay, when does a recession go from an issue to a problem? And I just remind everybody through the 90s, it was one of the best times to invest ever. Very low volatility. The market just kept climbing the wall of worry. That's what we called it back then. And it was a stall speed economy. We were, the definition of a recession is when you have 2 back-to-back quarters of negative GDP growth. It's more complicated than that, but that's basically the thing. And during the Clinton administration, we would have these barely growing, but not quite sometimes. And whether we're at a negative 0.2% GDP growth or a positive 0.2, it's just a really slow economy. It doesn't mean that we're slow down in Venice, Florida, but it's just slow. And that's steady, and it's really good for business and the financial markets. So that's kind of the thing that we saw, but where I was going with this is, when does that recession become a problem? So you have these kind of rolling recessions. When we have a recession that also has an exogenous event. Yeah. So in 2000, you had the tech bubble, and that was just complete overvaluations, and you had 9/11. Yeah. And then you had all the Enron, MCI, WorldCom, and all those other things. So we can go into recession and it would be okay. It wouldn't necessarily be a disaster. But if we're in a recession and some exogenous event happens, I mean, think about China invading Taiwan, for example. Sure. They wouldn't want to do it, and I can tell you all the logical reasons why, but sometimes, a la Putin, you don't do what's logical when you're a despot or you're a theocrat. So we got to be adults in the room and say that could happen. Another thing to watch is what's going on with our federal government and our budget deficit. And I feel kind of funny about this because those of you that have been clients for a while, you might remember in 2008, I did an economic review and I used Robert Johnson, who is a blues guitarist. And he wrote a song about the Johnstown flood, where everybody was living good and the dam was there and then the dam broke. And in hindsight, you should have realized that the dam was going to break, but nobody did. And I was talking about the flood being the amount of government debt that we had. Because back then, it was the first time, 2007, 2008, that we started doing this thing called quantitative easing. And so for 15 years, I've been really concerned about the budget deficit. And guess what I'm concerned about now is the budget deficit. So here's what happened 2 years ago when the market went down 20%. There was a decoupling. The Federal Reserve was saying, we're going to keep interest rates steady, and yet interest rates kept going up. Tell them about what happens with the bond market and the auctions.
Right. Well, really, the Federal Reserve can control the interbank lending rate, which is what banks borrow and lend at. But really, the long term is much more set by supply and demand. Basically, the Treasury will do an auction, and it has to do with bids that come in. And if there's not a lot of demand out there, well, that's going to push yields up and up and up.
Yeah, and so what we saw happening was the Fed was saying we're going to keep rates steady, and interest rates were going up. There was a decoupling, and that gives the market the EBGBs. Because nobody wants to realize that when you pull the curtain back, there's no magic wizard controlling the levers.
Right.
And the Fed's got to do this incredible landing stick, which they've got to keep the confidence of the world and of us that they've got this, that they've got it. And then they've got to do this incredible thing, which is stick the landing. It's incredibly difficult. So you see here on the top right, the federal deficit and net interest outlays as a percentage of GDP, it's the highest we've ever seen. And there's a bunch of the tax something act from 2017. A lot of the Trump tax cuts are set to expire. And if they are not re-upped, you can see that the growth in the federal deficit will be lower because you're going to have these taxes. But if they are re-upped, you can see how even the deficit gets even higher.
Right.
Now, when does a deficit become a problem? There's no magic number, but most economists say, hey, when you get to about 20% of GDP, that can be a problem. And you can see we're well above that. So we'll see. Japan's been running like that for a while, but who wants to be in the Japanese economy? The stock market isn't even back up to where it was in the 90s.
Right. Good point.
So anyway, that's something to keep around. Now, when you hear me say that, a lot of folks say, oh my gosh, the deficit's going to be a problem. We got to get out. That's not what we're saying. It's just we worry so you don't have to. So we're watching these indicators all the time, and if we start to see those signs, believe me, we'll be doing things in the portfolio to make amends and to prepare for it.
Sure.
So let's go on to our next slide, which is about the planning your race. And so the idea is that there are times to take risk in the markets, and there are times not to. Our thinking is that now's not a great time to, what I like to call it, chips in. Every once in a while, there's a situation where everybody is really panicking, and there's blood in the streets, as John Templeton used to say. That's when you want to buy. That's not now.
Right.
There's a lot of optimism. P/E ratios, as we'll see in this next slide, are really high.
Yeah, I think this is a great level set here, really to look over the last 30 years on where the S&P 500 typically trades from a valuation perspective. Right now, we're at 21 times earnings for the S&P, and we've only ever hit that 2 times in the last 30 years. And one of them was right after COVID, when kind of speculation was at an all-time high, and everybody had some stimulus checks in their pocket to spend. But certainly, it's something that we're tracking right now.
Yeah, the thing about PE ratios, you got to be a little bit careful, because when you had the COVID situation, earnings fell apart.
Sure.
So the stock market was down 30%, but PE ratios went up.
Right.
So it's not, but nevertheless, the stock market is not cheap.
No.
So we were talking about CrowdStrike, one of our bigger holdings, and it got crushed last week because of the whole Delta Airlines and the thing, and we said, oh, what's the price to sales ratio? It's still 19 times sales. It's like, still not cheap.
No, not at all.
We're seeing that all over the place. But so the stock market's high, and then we have a high concentration.
Well, that's certainly not helping that issue there. Right now, 37% of the total S&P 500 index is within 10 companies, the top 10 holdings. Market cap weighted, so the big tech companies like Apple, Nvidia, Microsoft, those are increasing their total share of that index. And the characteristics that are common between those big tech companies is they're expensive right now. And so if you piece out just the top 10 in the S&P 500, their current PE ratio is over 30 times right now.
I remember 3 summers ago, I was riding my mountain bike in Alafaya, and I bought on audiobook the Chip Wars by, it's not Donald Miller, but it's not Steve Miller because he had a rock band, but something Miller, and it was talking about how ASML and the difference between Taiwan Semi and who had this, and we came back and we just had a long discussion, and we loaded up on the chip stocks.
Yeah.
We got Broadcom, and we got Lam Research, and we got, and they've been incredible.
Sure.
I mean, that's why we've seen such good results.
Right.
But as I was thinking about it, looking at these valuations, we've had Microsoft, Amazon, Google. They're making enormous investments. So Google went down last week. It wasn't because they missed earnings. It was because they've got a huge capital outlay. They're laying out more money for the introduction of AI than Meta did for the metaverse.
Right.
And Meta, when they made their investments in the metaverse, went from 400 to 120.
Right.
So here's the concern that I have. The concern is that you've got two types of technology companies. You've got the technology companies of the chips.
Right.
Well, they're certainly going to make money. But how is Microsoft and how is Google? So Google's got this enormous search engine. They get paid for ads. And now they have their AI-inspired answer, which don't force you to go to ads. So they're making an enormous investment, but are they going to have an enormous return? I don't see where AI is going to make them more money, unless I guess we could pay a subscription price for it.
Sure.
And so anyway, there's some reason to see, maybe 4 years from now we look back on it and we say, yeah, I mean, AI is great, but it doesn't mean anybody's making any more money out of it.
Right.
But we'll see. So right now, our recommendation is based on these and some other factors that be careful of price earnings multiples. So we'll talk about this, but we're recommending going into companies without the high multiples.
Sure.
But this is interesting because it talks about the entry point of the PE multiple and the longer returns. Jake?
Yeah, I think it's important to understand the PE ratio is not going to tell us how the market's going to do tomorrow.
Right.
And it's not going to tell us how the market's going to finish the year necessarily. But looking back over time, what the PE ratio does a pretty good job at doing is gives us an indication on what the next 5-year returns could be for the market. And it's not perfect. You can't take the current PE and plug it into an equation and say, the market's going to be down 5%. But you can see the theme there that the lower the PE multiple is as an entry point, the higher the likely returns are over the next 5 years. Where right now we're kind of at the tail end of that and returns aren't looking so good.
So what you're seeing is on the vertical are returns.
Right.
And on the horizontal are PE multiples. And you'll notice on the left, where it's short term, it's a scatter.
Yeah,
It's hard to say anything. On the right, however, you smooth it out and you look at 5 years, and the further you go out on the PE multiple, further out you are on the right, the lower the returns.
Right.
So what we're saying is we have high multiples. We need to be more sanguine about pushing money into the stock market. But when you look at the stock market, there's a big difference between growth and value. We're seeing that value stocks are really quite attractive in a valuation perspective. Another thing that's happening is the VIX and volatility. The point of this graph is that we've had, I think last week we had the first 2% decline that we've had in a couple of years.
Right.
So volatility has been really low. It seems like it's high because we're at higher numbers.
Right.
It's 1,000-point move is like 0.5% now. But
volatility usually only rears its head to the downside because it kind of is climbing up and up and up. And
nobody cares about upside volatility.
No, not at all.
Oh, it went up too much. So anyway, you have this kind of 4 horsemen coming up. You have high valuations. You've got the Fed lowering rates, so you got a potential recession. You've got investor complacency, witnessed by this. So is it time to be really aggressive? The answer, in our opinion, is no. So this is more valuation measures and a little bit complicated. Bottom line is that bonds are pretty attractive. Stocks, not so much.
Right.
Next slide gets into the value versus growth, but this talks about research and development. So AI is real, and it is making a huge difference in businesses all around the country. I mean, just to get a sense, in our business, I can see that we're able to do more work with less employees.
Right.
And that's the magic of this, especially in the service industry. What used to take, to give you an example, the other day I've got this technology that I use called Dragon, which is a dictation software. And then we've got a Salesforce product called Salentica, which is a special Salentica. And it's all complicated. So I couldn't connect my Dragon to my Salesforce. And what I used to do is I used to have to call a help desk. Hello, give me my number is 4723. And now I just went on ChatGPT. I said, I've got this version of Dragon, this version of ChatGPT. I'm getting this. What did it do? And it tells me, I'm done in 5 minutes. So good stuff.
Well, the other thing about it too is from a business standpoint, and we've looked back and done a lot of studies on what really makes companies go from good to great,
right,
or average to great. And oftentimes it's the ability to reinvest and earn an excess return on your investment versus your cost.
Right.
And right now, if you look at the sectors of companies that are carrying cash to be able to invest in projects or that have historically done research and development and capital expenditures, it shouldn't really be a surprise that those have been the segments to outperform.
Yep.
And right now we're seeing that obviously growth has outperformed, and we're starting to see some value come in to the value stocks that from a multiple standpoint makes them look really attractive, but certainly from an earnings growth standpoint, it's coming from these 4 sectors.
So I think it's time to be buying value. And this is AI adoption, and you're seeing the hyperscalers really make a ton of investments. Everybody else not so much. The global electricity demand, so we're starting to see nuclear power make a comeback. There's so many interesting things that are happening from AI adoption. And the last piece we have on the state of the economy currently is what's going on with municipal financing. So top right, you see the total debt of municipalities versus the federal government. Municipalities look pretty good. So it's state and local municipalities. And then the bottom right, you see default rates. So muni bonds, state bonds, they've had a lower default rate than, say, corporates.
Corporates, yeah.
And what do you see on the left there, Jake, that looks interesting?
Well, we look at yield spreads here. And so comparing municipal bonds to treasuries, especially when you adjust them to a tax equivalent standard, really seeing some nice spreads in there that makes municipal bonds relatively attractive. And to Scott's point, from a default, if we compare municipal bonds to corporates, we're not seeing the spread there to really compensate investors right now to take that additional credit risk. So all that to say, we're seeing a lot of value within the municipal bond space.
Yeah, and if you think about the potential of a tax increase, that makes municipal bonds even more attractive. So the closing ceremony here, some of our thinking and comments we wanted to make. One is politics. So my opinion is that for a lot of people, they've become less religious and more political. And what used to be, I remember seeing a statistic where 20 years ago, parents would worry if your son or daughter was dating somebody from another race. And then maybe 10 years ago, it was, say, same-sex issues or 20 issues. Now, the number one thing that people are concerned about is not sexual orientation, it's not race, it's not socioeconomic, it's politics. It's amazing to me. Somebody that is really liberal would just not be able to accept a conservative member of the family, and vice versa. It's crazy. Yeah. It just blows my mind. But I think it's partially the impact of social media and how they heighten that sense of wronged and of just the other side is evil and bad. Check that, because it doesn't help you emotionally and spiritually, but it also doesn't help you with your investments. Do not make any investment decisions based on your projected outlook for the elections. We don't know what the folks are going to do, and what's more important than anything is that it's probably more likely with Harris's strong start. We went from who knows who's going to win. Trump had the first, especially with him getting the shot to the ear, so to speak, really dominant in the polls, and it looked like there was going to be a high probability of a Republican sweep.
Right.
I don't see, the people aren't talking about that now. We don't know. There's a lot of time built. But the point I wanted to make first is that the politicians will try to make this sound like it's the good versus the bad. And if we're elected, if our team's elected, things will be great. If the other team's elected, things will be horrible. Just don't buy into it from an investment perspective. And then also, the degree of difficulty in sticking this landing is tough. You've got high valuations. Consumer sentiment is too optimistic, really, based on the statistics that we have.
Weakening consumer.
Yeah. So all those things in the housing market. So we're kind of growth stocks. We got to be careful of taxes, and people don't like paying taxes and then seeing the stock stay where it is.
Sure.
But we never want to let the tax tail wag the investment dog. But certainly in some of these pockets of growth stocks, we just can't justify the prices that they're trading at.
Yeah.
I mean, they're not pets.com. No, what was the sock puppet company back in 2000? They're real companies. They're making real revenues. But, Cisco is still around, but it's still about half the price that it was in 2000.
Right.
So we got to pay attention to valuations. And then you want to take a couple last points?
Yeah, and on fixed income, we're seeing a lot of value there. But I guess quickly going back to around growth and around equities, right? The expectations are so high, and so that makes the sort of risk a lot higher too for any shortcomings.
Right.
That doesn't mean that all stocks are equal. We're still seeing incredible value within dividend companies, within some international stocks as well. Fixed income, we're still very, very attracted to, but really, these are at the margin.
Right.
We build the portfolios around really high quality companies, and so there might be some short-term volatility that sometimes happens in an election year. But the cash flows for these companies, a lot of them are on a real basis, are just compounding, and that's what we want out of our companies. We are certainly concerned about some valuations there, and we're making some rebalancing when we see fit. But again, you're not going to see us kind of make these big swings either.
Yep, and last point there is don't let short-term pessimism wreck your long-term plans. I like to say that pessimists are smart, optimists make money. And it's so true. God has a plan, and in the long run, we know all things will work out for good. In the long run, you've never been wise to bet against America. In the long run, we find solutions to problems. In the long run, investments in technology, especially now, the future of technological innovation is going up exponentially. When you think about drug discovery, for example, in the use of AI in testing different drug compounds, is such an accelerant. I mean, we're able to test thousands of compounds in the time it would have taken us to test 2.
Right.
And it's just revolutionary. And there's so many new technologies that are going to be accelerated through the use of AI. So it is an exciting time. You don't want to get short-term pessimism so overwhelming to you that you miss that long-term growth stand. I mean, to me, it's kind of like watching Thomas Edison start to build out New York and not saying, electricity might be a good thing. I mean, you can kind of see it's happening. So with that, we want to thank you for listening and watching. Know that we're here for you if you have any questions. And God bless, and let's help our country stick the landing.